Hi, you're listening to Mind Your Business with Karla Dennis, and I am Karla Dennis. All the years that I've been in business, I have to tell you, I've seen so many business owners lose their business, make critical mistakes in their business because of lack of knowledge. I want to provide you with great tools and content so that you don't make these same critical mistakes in your business. All right, let's jump into Karla's mailbag. And you guys have been sending in some really great questions for me to answer on the air for you. We're going all across the gamut, but I love it because if you're asking questions, that means you're thinking about your taxes. And I want taxes to always be on your mind. All right, our first question comes from an individual who's 22 years of age. They are attending college full time and they work and they live with their dad. They're wondering, depending on their situation, whether or not they should claim themselves on their tax return or should their father continue to claim them on their tax return. Well, that really kind of depends, but I'm going to give you some information. Typically, until you're age 25, you cannot file as an independent student anyway to create your own FAFSA or to try to be on your own for purposes of getting a scholarship or any type of aid money going to school. That being said, if you are working and if you don't make over $9,600 a year, it's still worthwhile for you to be on your father's income tax return. He's probably in a higher tax bracket, so your deductibility of yourself is going to be greater to your father than as to you. So chances are you still need to be filing on your father's income tax return. The only way I would say differently, if your income was over $9,600 a year, or your father wasn't helping you with any of your living expenses, but it doesn't sound like the case. So stick with your dad just a little bit longer. All right. The next question that has come in is about a payment plan with the IRS. This person had a payment plan for last year, and they're wondering, do they need to pay in full before they can file their 2014 tax return or receive a refund? If you're currently in a payment plan with IRS, part of that payment plan says that you plan to stay current on any future taxes. So if you file a tax return where you're going to be getting a refund, IRS is definitely going to take that refund. Depending on if you only owe IRS and maybe you owe state, IRS can take your your federal refund and send it over to the state as well. So refunds are not a good thing if you're on an installment agreement. They're going to take that money and apply it back to your installment agreement. Now, if you're getting ready to file your tax return and you still owe, you owed for 2012, you have an installment agreement. Now you're getting ready to file 2013's tax return and you owe again, you're automatically going to default out of that installment agreement, and IRS is going to send you a nastygram that says notice of intent to levy. We want to be very careful. If that's the case, we need a strategy to lump both of those years together so you can figure out a way to mitigate the tax or pay the tax in one installment agreement so that you don't get that letter from IRS, because that means you're out of compliance. Another question that has come in says, I haven't filed tax returns for the last 3 years. What do I need to do to get this cleared up? If you're out there and you haven't filed tax returns for prior years, and if you have your records, great. I'm going to say get in with a tax professional and get your taxes prepared and get them filed immediately. When I have a taxpayer that's late, I'd like to have those tax returns hand carried to IRS office and get them stamped in, and I'd like to get a copy of that stamp that says IRS has received your tax returns, because the processing time on a tax return, especially not a current year return, can be anywhere from 8 to 10 to 12 weeks. So if we want to get a proof of filing very quickly, we want to hand carry them in. Now, let's say, for example, if you don't have all of your paperwork to file your tax returns. Maybe you lost some of your paperwork, you just don't know where it is. There are methods that we can use to recreate your paperwork. Certainly, we can go back to your banks, get owed interest statements. We can get that information. We can log into the IRS's website, get a record of accounts, see how much income they show that you've earned in those years. There are ways to recreate your taxes. But the key is to do it as soon as possible before Uncle Sam starts knocking on your door. Because once that happens, you're going to lose time. They're going to be pushing you to get those tax returns in, and the stress is really going to mount up. So certainly get in and get that handled as quickly as possible. All right. We have another question that has come in that talks about my husband owes back child support and is subject to the offset program. We filed jointly, married filing jointly. Will my refund be affected as well? Yes, as a rule of thumb, your refund will be affected. But I want to back up and I want to explain what the offset program is. If you're dealing with someone that has back child support has the highest order, meaning that if you have any refunds coming from anywhere, DMV, IRS, state of California, or any other revenue departments, those refunds are going to be redirected or offset and sent to the child support program to pay the back child support. Now, if you're going to do a married filing joint tax return, there's a form that you can include with the tax return that talks about an injured spouse, meaning that I didn't have anything to do with this back child support, so please don't hold my refund accountable. That can work, but it's not an absolute. I highly suggest when you have a situation with a person that's in an offset program that you file married filing separately. Like, don't even link your name into that equation, because trying to battle to get back a refund is a battle in itself. And I believe in preventing those battles by having the right measures in place. That was an excellent question. We had another question come through. Do I need to pay tax yearly on the interest of my investments or when I cash them in? I have both CDs and mutual funds. When you have CDs and you're earning interest on CDs, that interest is reported every single year. So yes, you do have to pay the tax on the interest that's earned. When you have mutual funds, some mutual funds you have to pay, depending on how they're set up. You have to pay the interest, the tax on the interest and the dividends of those mutual funds, depending on how they are established. So yes, you do, most definitely have to do that. So you want to kind of watch for that. You want to make sure that you watch for trades being made in your account. A lot of times what I see with clients is they'll have an account, mutual funds, interest, different stock funds that they have, and their money managers, financial planners are trading in their accounts all day long. They don't even realize it. Come January, you receive a 1099-B for the sale of stock, and you're thinking, I didn't sell any stock, and you're puzzled and perplexed. That's because your financial company or your money manager has sold that stock on your behalf, and you have to report that stock as income on your tax return. And of course, you can get a deduction for the expenses of purchasing the stock, but this is a reason we amend tax returns all the time. Typically, these stock transactions are coming out to you the first round in January. The companies are amending the 1099 forms notoriously every year. You'll get another one in February, and then you have to refile your tax returns. So if you're in that case, you want to be very, very careful and understand all of your tax implications. Get with your financial planner, get with your stockbroker, and know exactly what's going on there. That's really important. Another question that came in is, what are the steps and forms needed to set up a company with a DBA in California if it's an existing domestic S corporation? So basically, this person has a corporation. It's a subchapter S corporation, and they want to file a doing business as. So what you would need to do in that particular case is go down to your county office and fill out the proper paperwork for your S corporation to do business as 123 company or whatever the name of that company is. And remember, you have to file those DBAs in every county because it's a DBA. It's not a corporation. The corporation blankets you for the state that you're in, but a DBA does not. So that's very important that you handle that as well. We had another question come in about an S Corp, and this person has a DBA under their S Corp where they have a retail store. And they want to purchase a rental property somewhere to lease out to a tenant. not themselves. They want to just pick up some investment property they're going to lease to a tenant, and they're wondering, can they use the money from the DBA as the down payment and get a tax write-off? You can take money out of your DBA, you're doing business as you choose to do so. If you are an S Corp, you have to take that money by distribution or wages, but you're not going to get a tax deduction for the down payment for the property that you're trying to purchase. You're not going to get a tax deduction for that. Now, it would be different if the S Corporation was going to own the property. The S Corporation could get some benefits from it. But if you're going to take down payment money, buy an investment property, you're not going to get a tax deduction on that from the actual investment property. If you have any questions and want to talk to myself or my guests, please reach us at 800-721-7374. That's 800-721-7374, or reach us at nybuniversity.com. That's nybuniversity.com. Thank you so much for listening. I can't wait to have this conversation with you again next week. And remember, mind your business.